Imagine you're about to launch a new product, but your marketing team is still working on the campaign. You've already invested $100,000 in production costs, and every day that passes means lost sales and revenue. What's the real cost of delay? In this video, we'll explore the concept of the cost of delay, why it matters, and how you can calculate it for your own projects. The cost of delay is a crucial consideration in business decision-making, but many people struggle to understand its true implications. To grasp the idea, let's break down what happens when we delay a project or investment. When we put something off, we're essentially borrowing money from our future self, and that comes with interest. Think of it like this. If you borrow $100 at 10% annual interest, after 1 year, you'll owe $110. That extra $10 is the cost of delay. Now, let's look at a simple example to make this more concrete. Suppose you're planning to launch an e-commerce website and you've already spent $50,000 on product development. If you delay the launch by 3 months, you could potentially miss out on $100,000 in sales during the period. That's because customers are waiting for your products, and every month they wait means less revenue for you. But what about the cost of delay in more complex projects? Let's consider a construction project where delays can lead to significant costs due to labor, materials, and equipment expenses. If a project is delayed by 6 months, the total cost might increase from $1 million to over $2 million. That's a 100% increase. The cost of delay can be substantial in such projects. Now, let's talk about how to calculate the cost of delay. There are several methods, but one common approach is to use the time value of money formula. This involves calculating the present value of future cash flows and then subtracting them from the current project cost. Sounds complicated? Don't worry. It's simpler than you think. You can use financial calculators or even Excel spreadsheets to do this calculation. Quick recap. The cost of delay refers to the additional costs incurred when a project is delayed, including lost revenue, increased expenses, and opportunity costs. Calculating the cost of delay involves understanding the time value of money and applying formulas like present value. By considering these factors, you can make more informed decisions about your projects. So, what's the takeaway? When evaluating a project or investment, remember to factor in the cost of delay. It might be higher than you think. In conclusion, being aware of the cost of delay will help you make more strategic decisions and avoid costly mistakes. Let's dive deeper into the time value of money formula. This concept is crucial in understanding the cost of delay because it takes into account the fact that money received or spent at different times has different values due to factors like interest rates and inflation. To calculate present value using this formula, you need to know 3 main variables: the initial investment or current project cost, the expected return on investment (ROI), and the time period over which the delay will occur. For example, let's say you're planning to launch an e-commerce website with a development cost of $100,000 and you expect a 20% ROI on your investments. If you delay the launch by 3 months, you can calculate the present value of the missed sales using a financial calculator or Excel spreadsheet. This will give you an estimate of how much revenue you'll miss out on due to the delay. For instance, if the expected sales are $10,000 per month and you're delaying the launch for 3 months, you might miss out on $30,000 in revenue. Now let's talk about opportunity costs. When a project is delayed, it may mean that another investment or project opportunity is missed due to the lack of resources. For instance, if your construction project is delayed by 6 months, you might be unable to take advantage of a lucrative government contract that requires completion within a specific time frame. To illustrate this point further, consider a scenario where a small business owner has invested $50,000 in a new product line, but delays its launch due to production issues. As a result, they miss out on sales opportunities worth $100,000 during the delay period and also lose potential revenue from other products that could have been launched concurrently. Calculating opportunity costs involves estimating what you would have gained if you had completed the project on time. This can be done by analyzing market trends, competitor activity, and industry standards to determine how much revenue or profit you could have generated from an alternative investment or project. It's essential to note that calculating the cost of delay is not a one-time task. It requires regular reassessment as your project progresses. As new information becomes available, you may need to recalculate the costs and adjust your strategy accordingly. To make these calculations more manageable, consider breaking down the cost of delay into 3 main categories: direct costs, indirect costs, and opportunity costs. Direct costs refer to expenses directly related to the delayed project, such as materials, equipment, and labor. Indirect costs include expenses like administrative overheads, marketing, and other business-related expenses. Opportunity costs, as mentioned earlier, represent the potential gains from alternative investments or projects that are missed due to the delay. By categorizing the cost of delay in this way, you can better understand where your resources are being allocated and make more informed decisions about project timelines and budgets. In addition to these calculations, it's also crucial to consider the psychological impact of project delays on team members and stakeholders. Delayed projects can lead to decreased morale, increased stress levels, and a loss of confidence in the project management process. To mitigate these effects, consider implementing measures like regular communication updates, progress tracking tools, and incentives for meeting deadlines. By acknowledging the human side of project delays, you can take steps to maintain team motivation and ensure that everyone is working towards the same goals. In conclusion, understanding the cost of delay requires a multifaceted approach that takes into account financial calculations, opportunity costs, and psychological factors. By adopting this comprehensive view, you'll be better equipped to make strategic decisions about your projects and avoid costly mistakes. This holistic approach can also help project managers identify areas for improvement in their processes and procedures. For instance, if a delay is caused by inefficient workflows or inadequate resource allocation, it may be necessary to revisit and revise the project's organizational structure. By analyzing the root causes of delays, you can implement targeted solutions that address specific pain points. Consider, for example, a construction project where a delay is caused by a shortage of skilled laborers. In this case, the project manager might need to adjust the timeline or allocate additional resources to expedite the work. Alternatively, they could reevaluate the recruitment and training processes to ensure that they have a stable supply of qualified workers. Another critical aspect to consider is the impact of delay on customer relationships and reputation. Delayed projects can lead to dissatisfied customers, negative reviews, and ultimately, a loss of business. To mitigate these risks, it's essential to communicate transparently with stakeholders about project timelines and any changes that may affect them. Regular updates and progress reports can help maintain trust and ensure that expectations are managed effectively. By integrating financial calculations, opportunity costs, psychological factors, and process improvements into their decision-making framework, project managers can develop a more comprehensive understanding of the cost of delay. This enables them to make informed decisions that balance business goals with stakeholder needs, ultimately reducing the likelihood of costly delays and improving overall project outcomes.